Tax avoidance and tax evasion. Two terms that sound similar but sit on opposite sides of the law. One is a perfectly legal strategy used by individuals and businesses every day. The other is a criminal offense that can lead to prison time. Understanding the difference is critical for every financial professional, business owner, and informed citizen. Let's break it down clearly. Tax avoidance is the legal use of tax laws, rules, and regulations to reduce the amount of tax you owe. It operates entirely within the boundaries of the law. Think about retirement contributions, maximizing your 401k or IRA contributions to defer taxable income, or business deductions, claiming legitimate expenses for operations, depreciation, and research and development. You can also invest in municipal bonds or tax-advantaged accounts to minimize your liability. These are all lawful strategies that governments intentionally build into the tax code to encourage certain behaviors. Now let's look at the other side. Tax evasion is the illegal act of deliberately misrepresenting or concealing information to reduce your tax liability. It is a criminal offense punishable by fines and imprisonment. Common methods include underreporting income, hiding cash earnings or offshore accounts from tax authorities. Another is inflating deductions, claiming false or exaggerated business expenses to lower taxable income. And then there is outright falsifying records, submitting fraudulent financial statements or fake receipts. Each of these involves intentional deception, and that is what makes it a crime. Let's compare these two concepts across 5 key dimensions. Legality. Avoidance is permitted by law, while evasion is a criminal offense. Intent. Avoidance aims to minimize tax through planning, while evasion seeks to conceal or misrepresent liability. Methods. Avoidance uses deductions, credits, and legal structures, while evasion relies on hidden income and false records. Consequences. Avoidance carries no penalties because it is fully compliant, while evasion leads to fines, penalties, and imprisonment. And finally, disclosure. Avoidance is transparent to authorities, while evasion is deliberately concealed. Keep these distinctions sharp in your mind. Think of tax behavior as a spectrum. On one end, you have full tax compliance, paying exactly what you owe with no adjustments. In the middle sits tax avoidance, using legal tools to reduce your bill while remaining transparent. On the far end is tax evasion, crossing into criminal territory. The boundary between avoidance and evasion lies in two things: intent and transparency. The moment your tax planning involves deception, concealment, or misrepresentation of facts to tax authorities, it becomes illegal. Always stay on the right side of that line. Here is why this matters beyond just tax law. Tax evasion and money laundering are deeply intertwined, often two parts of the same criminal enterprise. The process works in 3 steps. Step 1. Generate hidden funds. Tax evasion creates pools of undeclared, off-the-books cash that must be concealed from authorities. Step 2. Launder the proceeds. Money laundering disguises the illegal origin of those funds, making them appear as legitimate income. Step 3. Re-enter the economy. Cleaned funds are reintegrated into the financial system, often through shell companies or real estate. This is why anti-money laundering professionals must understand tax crimes. Let's look at the tools that connect tax evasion to money laundering. Shell companies hide true ownership. Offshore accounts conceal funds abroad. Real estate is used to park illicit cash. False invoicing fabricates paper trails. And cryptocurrency enables anonymous transfers. Tax evasion generates the illicit funds. Money laundering provides the cover. Together, they form a cycle that undermines financial systems, deprives governments of revenue, and facilitates further criminal activity. Both crimes are prosecuted under anti-money laundering or AML frameworks globally, including FATF guidelines and the Bank Secrecy Act. The consequences are staggering. An estimated $600 billion in global tax revenue is lost to evasion every single year, according to the Tax Justice Network. In the United States, the average federal prison sentence for a tax evasion conviction is 5 years. The United Nations Office on Drugs and Crime estimates that 2 to 5% of global GDP is laundered annually. That is an enormous sum flowing through criminal channels. And the maximum civil fine per count of tax fraud under US federal law is $250,000. These are not abstract numbers. They represent real enforcement actions happening every day. Let's recap what we have covered. First, avoidance equals legal. Using lawful strategies to minimize tax is not only permitted, it is smart financial planning. Second, evasion equals crime. Deliberately hiding income or falsifying records crosses into criminal territory with severe penalties. Third, evasion enables laundering. Hidden funds from tax evasion frequently serve as the raw material for money laundering schemes. And fourth, intent and transparency draw the line. Always err on the side of full disclosure. If you remember nothing else from this session, remember this. The difference between a sound tax strategy and a criminal act comes down to honesty with the authorities.